Have you been thinking about buying a home, but maybe you feel a little bit overwhelmed on, where to start? Or do you wonder how your credit, your debt to income, and how that may actually play in your ability to actually qualify to get a mortgage? Good evening, guys. My name is Alan Pender. I'm a U.S. Navy veteran. I'm a father. I'm a husband, and I'm passionate about sharing ways that you guys can not only achieve your financial goal, whether that be home ownership or better credit, but giving you guys actual steps that you can do to be able to make that dream come true. Now, in today's video, we actually have an expert in the field, Senior Loan Officer Trelise Witherspoon, with over 30 years in not only the financial literacy industry, but also with a few years in the mortgage broking space. And today she is going to be able to share some powerful insights that will help you go from you don't know to clear to close. Now, without further ado, I'm gonna bring on Miss Trelise really fast and let her introduce herself as well.
All right. Well, hello, everyone. I am Trelise Witherspoon. I'm with Barrett Financial Group. I have been in the financial industry since the age of 19, and I am 54. My first job in this industry was as a credit investigator with a major automotive finance company. I worked there for 14 years and then transitioned into the mortgage space in 2002. 2002. And I started off as a loan officer, originator. I also am a past licensed realtor for the state of California as well as Arizona. I transitioned full time into the mortgage space in 2008. And right when I transitioned, that's when the financial crash happened in 2008. So at that time, I had to kind of switch things up. And then I went into underwriting. And I started my first career with Chase Bank and then transitioned to Wells Fargo. And then I've been with Quicken Loans. I've been with a lot of the major mortgage lending companies. But my passion has always been about origination. And the reason being, years ago, God gave me a command and he put it on my heart that he wanted me to teach his people to possess the land. And I've made that my life mission, is to actually be able to teach his people to possess the land. And what that means is if you have a desire to be a homeowner, well, a lot of loan officers aren't going to take the time to really teach you that process. If you're not ready, they're going to let you know, hey, sorry, you're not ready. Maybe come back in a year and we'll work with you. But I don't do that. I literally put my clients on a step-by-step plan, and I hold your hand throughout the whole process from day one. If it's credit issues, hey, my partner Alan is here. Let's get your credit in order. And I'm going to take you from A to Z, as well as give you the financial literacy piece that most people won't tell you about, as well. And to show you, hey, you're not only going into home ownership, but you also need to begin to think like a homeowner. The mentality of a homeowner is way different than being a renter, because now, guess what? It's your home. So that means now you're responsible for everything. You can no longer call the landlord. This is your home, and you need to be in a financial position. If anything comes up, any repairs, whatever, you have to be the one to take care of those responsibilities. So, my goal is to not just possess the land, but also know how to manage it and how to steward it. That's the key. You have to know how to steward what God gives you. So I'm here today to talk about that process and to share as much as my knowledge and my wisdom, and, to really give everyone the tools that they need to be successful at owning a home.
That is
Thank you.
that is fantastic right there. Here, let me do it like that way they can see both at the same time. Wow.
Okay.
I'm just gonna ask a couple of questions, per category, and we're gonna leverage some of your amazing knowledge. The first question that comes to my mind: what credit score is typically required to qualify for a mortgage?
Well, with FHA, you only need a 500. But with 500, you also need 10% down. So your assets are going to be a major key with that 500. But in order to qualify for an FHA or VA, VA, of course, is no money down. FHA is at least 3.5% down. You need a minimum of a 580 FICO score. So most clients, like I have a lot of clients that are credit challenged. If you're short of what that minimum requirement is, then we do a total analysis of, what is actually impeding your score from being able to increase. And once we devise a strategy to increase that, then at that point, I'm going to turn you over to my credit repair partner and say, hey, let's work on these items and let's get them ready. But I do the initial analysis up front. I have tools in my toolbox that I'm able to use and will simulate for me, to show me if we work on these specific items, that'll put my client where they need in order to be able to qualify. And I've helped many of my clients be able to qualify in that way.
Wow.
So.
Okay, that's pretty decent. Okay, you kind of answered one of my questions within that question answered just now, but another one that comes to my mind. So, how does a person's credit history affect their ability to buy a home? Because, some people feel like I messed up my credit 10 years ago. I'm going to never be able to own a home. What do you say about that?
Well, credit history accounts for your credit history accounts for at least a good 50% of your FICO score. Okay. The other major key player is your revolving credit utilization. That accounts anywhere between 35 to 40% of your FICO score. So those are the two biggest key elements to having a good FICO score. People don't realize that, and I say this all the time, honestly, credit is a game. It's a game. And if we don't know how to play the game, then guess what? You lose it. You see what I'm saying? So we have to understand how to play the game. All right. So I share this with a lot of my clients because they may have decent credit, meaning they've got some revolving credit lines and all this and that, but yet their FICO score is too low to qualify, and they can't understand what's impeding their FICO score. And when I pull the credit report, and by the way, I do a soft pull. I don't do any hard inquiries the first time. I do a soft pull. That way, it allows me an opportunity to be able to analyze and see, okay, how do we need to strategize here to work with this client and get them in position? So I have a client, they may have decent trade lines, but yet everything is maxed out. Well, guess what? You using all of your utilization like that is going to impact your credit score, as the utilization accounts for 35 to 40% of your FICO score. So the goal is to get your usage at least under 30%. So if you have $1,000 credit limit, well, guess what? You can only use $300 of that. And what I strongly suggest my clients to do is keep it below 10%, because that's ideally where FICO wants to see it. They don't want to see it maxed out. They want to see people being good stewards over it. Okay. And if you have a balance, pay it off the next month. Don't keep rolling it over, and then you're incurring all this additional interest and finance charges on top of that. That's just continuing the cycle of debt. Get out of debt. That's the goal. Have a plan in mind. Okay, if I got to charge something, I got an emergency coming up. Okay, boom. By this next pay period, I need to have this paid off, or at least make sure that balance is back under 30% on my utilization. Your goal should always be maintaining a utilization over all your credit cards. And we're talking about revolving, because your installment loans don't play a factor in that. Your revolving credit does. So any type of retail credit cards that you have, any type of MasterCard, Visa, American Express, That's what's impacting that score on your utilization. So credit history is important too. Understand though, for an FHA loan, you only had to have been out of your bankruptcy from the discharge date 2 years. After 2 years, you can go buy a house. You know what I'm saying? So, but the thing is, maintaining a good, consistent payment history after you filed a bankruptcy. When you file a bankruptcy, you've got a clean slate. It's time to start fresh. It's time to change your mindset. Don't go back and repeat the same old habits that got you in that bankruptcy the first time. And I know, okay, because I've been there before, okay, a couple of times already. I'm not even gonna lie, been there before. So it's a hard life. Okay, I learned my lesson. We're not going back there. All right. So what you want to do is you want to start developing better habits, new habits of managing your money. That's the key. Proper money management. Put yourself on a budget, because when you become a homeowner, guess what? You have to know how to budget. You have to know how to budget. It's not going to be easy. All right. Because you're no longer renting. So you can no longer call the landlord and say, hey, I need this and this done. No. When that dishwasher breaks down, guess what? You got to have that money out of your pocket to be able to go fix that dishwasher, to go be able to replace that refrigerator, or whatever happens. And I always say, put that money aside at least 6 months for a rainy day. That should be our goal always, at least 6 months for a rainy day. But in terms of the credit is, FHA, and I love working with FHA buyers, because a lot of times they think, oh, I can never buy a house, my credit's too bad. And then come to find out, they come to me and I'm like, oh yeah, we can get you ready in, 30 days, maybe 60 days, sometimes a little longer. But typically, if they follow the strategy that I lay out for them, we typically can turn it around pretty quickly and get them ready to be able to buy. One key thing I was going to mention though, the biggest challenge that most buyers have is, of course, in addition to the credit, is also being able to have the money for the down payment. And I'm sure we're going to get into that, but that's another subject that I want to make sure we discuss. But go ahead, Alan. Sorry about that.
You're right. I did have down payments later on down the list of my list of questions. But while you was on that topic a second ago about those debts, because I did have a really good one. How can, I guess, paying down specific debts improve someone's chances of qualifying for a mortgage?
Okay. And keep in mind, installment loans paying off an installment loan is not going to change your FICO score. Leave those alone. Most people are like, oh, I'm going to pay off this installment loan. And then when I look at it, I'm like, no, that's not what we need to address. What we need to address is the revolving debt. Revolving debt is what accounts for 35% of the FICO score. So that is what you want to focus on, keeping that utilization below that 30% threshold, ideally 10%. And that's where you want to keep it. That's where you want to maintain it. Another thing that I want to mention real quick, I've worked with buyers before. We're in the process. Offer accepted on the house. Here we are going through the loan. I've already given you my disclaimer. Do not go out and open any other loans. Wait until we close. Guess what? They didn't listen to me. They didn't listen to me. When I bought a car.
I like that.
And then disclose it to me or anything. Understanding the loan process, the lender will pull another credit report right before closing. That's why it's important that you do not go out and get new credit when you're trying to buy a house. Wait until after you close, the loan is recorded, all of that. You want to go buy a new car, you go right ahead, be my guest. All right? But no, don't do it, because you could potentially shoot yourself in the foot, sabotage your own deal, because you went and took on new debt, and guess what? Now it's impacting what's called your DTI, your debt to income ratio. You can qualify for a mortgage.
There you go. Okay.
You can no longer qualify for a mortgage. For a conventional loan, the maximum DTI cannot exceed 50%. For FHA to VA, sometimes it's 50 depending on the credit overall risk factor. Sometimes it's 50, sometimes it could be 55, sometimes it could be lower. You know, if you're a manual underwrite, then it's not going to be over 43. Right.
Okay.
So talking about your overall, so if you got student loans, you got credit cards already, you got installment loans and things like that, and then you decide to go get something else, well, guess what? You just shot yourself in the foot. You know,
While we're
so
on that subject of student loans, because that was another one of my questions, how does
mhm.
having student loans and credit card debt make it harder to get approved for a mortgage? You know, a lot of people got credit cards and student loans. So what does that,
Yeah.
how does that affect their mortgage application?
Okay, so one biggest key about student loans is that they're not going anywhere. Okay, unfortunately, we saw that Joe Biden said people were going to get student loan forgiveness. Did how many people got that student loan forgiveness? Probably like less than 10%, if any. Okay, so they're not going anywhere. So the main thing with an FHA loan, the way they address student loans, if you don't all if a payment amount is if a minimum payment amount is not already reported on credit, if it's not showing a payment amount, more than likely that means that you're in a forbearance on your student loan, which most people are. So what FHA tells the underwriter to do, well, we want you to go ahead and calculate a payment at 0.5% of what the balance is of that student loan. So
Hmm.
the underwriter is trained to automatically add a payment of 0.5% of that outstanding balance. So, I mean, if it's 200K, guess what? You're going to automatically get a payment hit to that. Now, I don't know what that number is, maybe $1,000 a month or whatever. Whatever that amount is, that's going to be added into your monthly debt to income ratio. Okay. So you're like, well, I don't have to make a payment on that. It's on a forbearance. Well, in the lending space, we're going to add a payment regardless. You're going to get hit with a payment on that. Okay. Now, the one thing I like about conventional versus FHA. Conventional, meaning Fannie Freddie loans, if you can qualify for those, because the minimum FICO score on those loans is 620. And then not only that, you can have a 620 and still not qualify because Fannie and Freddie, for conventional space, they're going to look at the overall risk of the file. And if the overall risk of the loan does not fit their criteria, then you can still get denied for a conventional loan, even with having a 620 FICO score. So keep that in mind. They're going to look at the overall risk. So basically, if you've had bad payment history or slow pays, or you've got collection accounts, or you've got charge-offs and stuff like that, they're going to factor that into their overall risk criteria, and they're going to say, no, not a good candidate for a conventional loan. And then you're going to have to switch to an FHA. So, but the good thing about conventional versus FHA, conventional say, well, if this borrower is on what's called an IDR, meaning you're on a repayment plan with your financial institution for your student loan debt, and if that IDR says that payment is $0 a month, well, then guess what? They're not going to factor in a payment. They're going to qualify you based off of that $0 a month that's showing on that letter. So that's a benefit of doing a conventional loan versus an FHA. FHA, regardless, across the board. IDR, no, you're going to get impacted, with that monthly payment as calculated by the underwriter.
Okay, okay. Now let's talk about the money now, like down payments and closing costs. I guess how much should someone have saved up to get down payment qualified? And I guess are there any programs or kind of payment assistances that are maybe available to people?
Yes, yes. And I'm going to tell you right now is a really good time to buy, only because we have so many down payment assistance programs is just beyond. We have lenders that are giving, up to 5% on the down payment for FHA. You're only required to come in with 3.5%. If they're giving 5%, that means they're giving you money for your closing costs as well. I like to tell my clients to always have at least 5% available, just in case. Because you have to understand, you're going to be paying for the cost of the home inspection. If that house has needs termite treatment, guess what? You might be paying for another termite inspection. Okay. You will be paying for your appraisal. There's out-of-pocket costs that goes into that transaction, not including your earnest money deposit. And so depending on what's going to be required, the realtor and the buyers and the seller's realtor will work out all the details, but the buyer needs to be able to have money available to be prepared to even come to the game. You know what I'm saying? So I always tell my clients at least have somewhere between, if they're planning on using down payment assistance, okay, then you need to at least have at least 3% stored somewhere. 401k, maybe we can tap into that. And wherever we need to go and get that additional cash, even gift funds. If you have a parent or a spouse or a friend, or not necessarily a friend on the FHA, because it has to be a relative. So if you have a sister or a brother or someone that can gift you that money, get gift funds and be able to, make that transaction. Because, down payment assistance generally is going to give you 3.5% for your down payment, but you still have your closing costs. And that closing cost can range anywhere between, depending on, if you're buying down an interest rate or, whatever else goes into that transaction, closing costs can be anywhere between 2 to 3, maybe even 4% right there. So you have to be prepared for those things. That's why I say, I always tell my clients, look, you need to have at least 3 to 5% in the bank. Even with down payment assistance, you need to be able to have your own money. You're trying to step into the game of being a homeowner. The investor is going to assume a lot of the risk, but guess what? You're also going to pay for the risk that investor is assuming. Because that interest rate, if you're not coming in with any money of your own, well, then guess what? That means your interest rate is going to be higher. So you have to prepare for that. You're going to have a higher interest rate because you're not coming in with any money of your own. If you need the down payment assistance, great, get it. But my best advice is that save your money and have your money ready for your down payment. And that way you can come in with the best interest rate that you're able to qualify for. You know what I mean? And, you don't have to pay any additional finance charges because you're borrowing money for your down payment. Literally, one other strategy that was useful for me when I was a realtor and that I encourage a lot of my clients to do with their realtors that they're working with is also negotiate that the seller pay your closing costs. Trust me, if that seller is motivated to sell that property, FHA allows you to request up to 6% on your closing costs. So you figure all your closing costs will be covered by the seller. And it's a negotiation process. So the seller could come back and say, no, we don't want to pay you 6%, but, we'll agree to give you 3%. Okay.
Okay. Negotiation.
You definitely want to, open up those lines of communication. Make sure, that when that offer is written, that it's written in your favor. You want to make sure that you ask for, you can only ask. So you want to ask for everything that you feel like you possibly can qualify to ask for. You want to ask for that. So, yeah.
Now, what about the mortgage and preparation progress, right? I guess, how does the pre-approval process work and why is that so important?
Great question, Alan. Great question. So when it comes to pre-approvals, now there's two different qualifications. There's a pre-qualification and there's a pre-approval. All right. So the difference between the two, when I'm doing a pre-qual, Basically, I'm doing a soft pull. I'm having a phone conversation with the client, a verbal consultation. I'm taking down all of the demographic information, the income, the assets, just based off of a verbal conversation. So based off of what the client is telling me, then I'm able to take that information, plug that information into my system, and then I'm able to say whether or not I can qualify you or not. So based off of the conversation only, I'm able to generate a pre-qualification. All right. So that's the difference between a pre-qualification. Now with a pre-approval, the client not only has given me all their verbal information, but they've also sent me their documents. So I'm looking at income, I'm looking at assets, we're looking at credit, we're looking at the overall financial picture of the borrower. And then another step that we can take it to is even submitting that file to an underwriter and getting what's called a conditional loan approval. So that's the difference, meaning that loan's already gone through underwriting. And because that loan's already gone through underwriting, I can give you what's called a pre-approval, and that pre-approval will allow you to shop for a home. And guess what? By the time you have your contract written up and it's fully executed, well, now guess what? The underwriter's already seen your income. She's already seen your assets, or she or he already seen the income, already seen the assets, already seen the credit. Pretty much the only thing that they need to look at now is the terms of that contract. So that helps to expedite that loan process even faster if you want to fast track your loan, because your loan literally has already been underwritten. So that's the difference between a pre-qualification and a pre-approval.
Now, I know there's a bunch of different kinds of loan types that people can do, VA, FHA, USDA, conventional, jumbos, a whole bunch of them, right? I guess, how can you help someone decide which loan option is best for them?
Great question. Great question. So what I do is when I look at an overall borrower, number one, I have a conversation. I have a conversation with the client to find out what their goals are. So depending on what their goals are, if they can qualify for a full document loan, then okay, we have that available. If they don't really have a strong income history, or some don't have any history at all, guess what? I still have a loan for you. So depending on what their financial goals are, that's going to determine what type of loan I'm able to actually get them placed in, and for them to be able to qualify and be able to move forward.
Ooh, okay. Now, this is some great information. I only got a couple more, general questions for you, just kind of to pick your brain a little bit.
Okay.
What are some common, misconceptions or myths about, the mortgage or the home buying process that people need to be aware of?
Okay, good one. Let's see. Well, number one, the credit. A lot of people think, okay, because my credit is so low, my score is low, it's bad or whatever, I can never be able to own a home. That's one of the biggest myths. People think, their credit is just, putting them behind the 8 ball and they can't qualify. I will tell you this. Like I said, it is my mission to help God's people possess the land. A lot of loan officers don't have the time or the patience to do that. I'm not here for that purpose. When I was an underwriter, and I was an underwriter for 15 years, when I was an underwriter and I would see a lot of clients, loans coming across my desk, and a lot of them were getting denied when they made it to my desk, because guess what? They were not properly structured. They didn't meet the qualification of the loan program. Because unfortunately, a lot of loan officers don't even know these loan programs, or they don't know how to structure a loan themselves, unfortunately. So when I'm looking at a client for the first time, I'm going to make sure that loan is properly structured, because guess what? I'm already underwriting you. Soon as I pull that credit report, soon as I get your docs and all of that, I'm already underwriting you. So that loan is going to be underwritten up front to make sure that it's going to flow and pass all the requirements as outlined per the guidelines. And that's very important for a loan officer to be able to understand how to read guidelines, because a lot of them don't, unfortunately. They don't take the time to, and so that's what's really important for people to know. You need to be able to have a loan officer, and it doesn't have to be me, okay? Because everybody is allowed to work with whoever they want to work with. But I'm going to tell you right now, if they're not taking time off for you, if they're not returning calls, if they're not showing up, if they're not, guess what? You might want to think about getting another loan officer, because that person is not really working in your best interest. So, the goal is to be able to, get the client in a position, where number one, we're teaching them financial literacy. If they don't have any concept of that, we're teaching them financial literacy, and we're setting them up for success. That is my objective, is to be able to teach the people to be able to possess the land. Right now is a prime time to get yourself ready and get in position to be a homeowner. We're going into a whole new year, and I'm gonna tell you, I have really good feelings about what's getting ready to happen in 2025.
Okay, I got like 2 more questions. Okay.
Okay.
This is gonna be more theoretical, right? But
all right.
Say I woke up tomorrow morning, right? God gave me a blessing to wake up tomorrow morning, and I decided, you know what? I'm tired of renting. I want to be a homeowner. What is the first thing you recommend I go do?
Talk to me. You need to call a loan officer. Because let me tell you this. A realtor doesn't even know the time of the day until you have a pre-qual in your hand. They don't even want to know, like, let me talk to my lender, okay? It's your time.
Can't hear you that well.
First thing you need to do is get in contact with your trusted lender partner. Number one. Say, hey, I'm tired of renting. I'm tired of just renting this. I'm tired of paying somebody else's mortgage. What can I do to get myself in position to be able to own my own house?
Yes.
Okay. And then devise a strategy or a plan, whether it's going to take a few months, or whether it's going to take 6 months, or whether it's going to take a year. Devise a strategy and stick to it. Stick to the plan. Put yourself on the budget. If you don't have the money for the down payment, whether you plan on using down payment assistance or not, everybody can't qualify for down payment assistance. Not only that, down payment assistance may not be available by the time you get ready to qualify. Okay? Because them programs come and go. They're not here all the time. They come and go. Okay. And when those grants and those investors run out of money, guess what? They may not bring it back. Okay? So you always want to be able to have, and that money set aside regardless, whether you need to use it or not. Have that money available. And that's the thing, get a goal, get a plan, get a budget, and stick to it, and, be able to execute when the time is right.
I love it. Okay, well, last thing, any closing remarks, and also make sure you let the chat know how and where and when they can get in contact with you.
Okay. Well, I just want to say, Alan, I appreciate the opportunity to come and, speak with you on this topic. I mean, I love mortgage. I love what I do. Like I said, I was an underwriter for 15 years. I'm extremely analytical, and it took a lot for me to come out of an underwriting space, because underwriting is also my passion, because I'm extremely analytical, and, I'm always thinking, okay, how can we make this deal work? So I love doing those things, for people. But, the time, the space where God would have me to be would be on the front line. And that's where I'm at today, because that way I can make myself available to people so that we can be able to, it gives me an opportunity to be hands-on, to be able to say, okay, we need to do this and this. In the underwriting space, guess what? I can't have any communication with the bar at all. It's not allowed. Okay? So I'm operating in my divine purpose. You know what I'm saying? And because I acknowledge that and I know why I'm here and I know what God brought me here for, guess what? The job's going to get done. My loans have a 99% closing rate. And if it doesn't close, then guess what? That client just went out and got a car and didn't tell me about it.
That's your opening scene right there.
That's why I didn't close.
That's gonna be
That's why I didn't close. Okay. So I take what I do very seriously. I'm always looking out for. I always have my client's best interests at heart. And if you are interested in working with me, I want to say this. I'm personally licensed in Arizona, California, Texas, Michigan, Florida, Washington, and Montana. But the company that I work for is licensed in 49 states, all 49 states except for New York. So if you do reside in the New York area, I do have lender partners in New York that I can refer you to. But you're more than welcome to still call me, and I'm always available. I'm an open door. You can always feel free to send me a message, DM me, call me, and ask me any questions that you need to ask me, because I'm here to help the people. I genuinely care about people. All right. But you have my contact information. If you could.
Yeah, I got you. It'll be, yeah, I got, yeah, just take
Okay.
it and I'll make sure to put it in the description.
Okay, perfect. So Alan has my contact information. If you are interested in working with me or having a conversation with me, reach out to him because he is my credit partner. Reach out to him, and then he can make sure that, you know, he gets, you know, your information over to me, and then we'll go ahead and we'll set up a strategy sessions. Like I tell you, I do a soft pull. So it's not going to hit it's not going to be a hard inquiry on your credit. Once we look at that credit, I can tell you exactly, okay, we need to work on this, 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 and this. And one thing I like to always share with my clients, and here it is. This is a story from when I first started working in the credit industry as a credit investigator. My first job at the age of 19 was working for Toyota Lexus Financial Services, and I was with that company for 14 years. Okay. I started with them at the age of 19 as a credit investigator. And I remember this one loan. It was a 19-year-old kid who had walked into one of our Toyota dealerships, and he was buying a big old Tundra, $30,000 vehicle. He was 19 years old. And when I pulled his credit, his FICO score was over 800. And I'm looking at the account, I'm reviewing, you know, I'm scrutinizing the accounts and everything, and I'm like, this is not making any sense to me. Okay, how is this 19-year-old kid walking around with an 800 FICO score, and then I'm looking at accounts on his credit bureau that have been open even longer than he was even born? How is that even possible? So I immediately go to, okay, we got a fraud deal. Okay, I got to go take this one to my manager. This is fraud. It's got to be fraud. So I walk into my manager's office. I'm like, hey, I need you to look at this. You know, this dude's got an 800 FICO score. He's only 19 years old. He's trying to buy a Tundra. I think we got a straw purchase here. You know, this doesn't even make any sense, right? And Alan, you see how you sitting back laughing? That's exactly what he did. He had a straw in his mouth, and he was rolling.
That man got some good parents.
It makes no sense to me. He's like, Trelise. He's like, you see this account? And let me tell you, the credit line, the credit limit on this account was $100,000. Yeah. The account had been open for over 20 years. It had been open for over 20 years. It was for $100,000. And guess what the balance was? $10. $10. And he's like, do you see that? I said, yeah. Like, I understand, I'm new, I'm 19. He said it's because, look at the e-color code. He's an authorized user. His parents added him as an authorized user. And he's literally piggybacking off of his credits, off of his parents' excellent credit. And that's when the light bulb went out. That's when the light bulb went out in my head. That's
Inspirational.
when this understood at that point. This is a game. And in order to be winning, we have to know how to play the game. That's
I think something's going on with your speaker.
you can't hear me?
There you go.
Okay. But his parents set him up for success. And we have to also have the same understanding. Understanding that now, guess what? I do that for all my children. I set them up for success. Every last one of my children have over a 700 FICO score. Every last one.
Say it again.
Every last one of my children have over a 700 FICO score. Every last one. And I don't just set them up, but I educate them on proper use of the credit, how to maintain it, how to be a good steward over it, okay? Keeping those low balances on their accounts, all right? So that right there, that just took me, because there's so many people in our community that don't even have a clue about that. Guess what? My parents never taught me. God set it up where I could go into the financial industry at the age of 19 and learn it and be taught this. But my parents never left me an inheritance of knowing of proper finance and knowing how to manage money. My parents and most people in our community, unfortunately, our parents don't teach it. They don't know. It's not something that's common sense in our community, unfortunately. It's through trial and error that we learn. So what I know, what I've had an opportunity to experience in my 30 years of being in this industry, guess what? It's my goal to share it with everyone that I can possibly share it with, and get that word out and help the next person be able to, like I said, possess the land. That's the goal. So yeah, if you're interested in meeting with me, we can have a strategy session. I'm available. We'll make room and get you on my calendar. But in the meantime, Alan has my contact information. Alan, you might want to put something. I don't know if there's a chat or something, but if somebody wants to speak with me, I'd be more than welcome to set something up and talk to you, for sure.
Definitely. Well, this is gonna be my
Thank you
later, so they're gonna be able to comment. But
okay,
man, I want to thank you guys. I want to thank you for being on this video just now, giving us this information, guys. Once again, you just heard from Trinice Witherspoon, senior mortgage loan officer, and so many more. Now, I hope that something she said, because I know it gave me some value. I hope something she said just now will give you some value. And in the meantime, between time, y'all stay blessed by the best.
yes.
Goodbye.
All right, peace out.